Hello, welcome to Managerial Accounting. We're going to talk about operational and production budgets. As I have done in the past, I want to just remind you of what we discussed in the previous chapter. Our last chapter we talked about budgets, but we also talked about capital expenditures, purchasing long-lived assets and financing them, and trying to determine whether or not these assets we can get a return on our money using a payback, or looking at the time value of money. It's all about evaluating the purchase of these assets and trying to estimate whether or not the investment is worth the capital expenditure. It was a very interesting chapter, and I think would be very helpful for you to review some of those concepts and understand why organizations really take the time to analyze whether or not the purchase is the correct one and how it's financed. Today we will talk about budgets, why they are used, how to prepare those budgets, and really how we as management accountants can provide useful information to these individuals so that they can make very practical decisions. So why would we budget? Well, we really want to know how what we can do, how we can do it, and we evaluate what's done. Budgets allow us to utilize the process of how we're going to spend our money, where do we spend our money, and then compare what we believe we're going to do with reality. So it becomes quite important for an organization to know why a budget is important. We want to be able to allow us to control what's happening within our organization, and budgets really set parameters, very effective parameters if done right. And it's also imperative to use it as a baseboard for strategy. How do we do it, what we do, and the steps we need to follow in order to carry out this plan. And so that plan is most certainly your budget. So the mission and the purpose is going to really guide the budget. And I say that because really what you're trying to accomplish and how you are going to accomplish it is going to set the parameters of what you're going to do and how you're going to do it, and the financial resources that you'll need to carry that out. Strategic planning usually is a 5 to 10 year plan in the future, but most often budgets are usually 1 to 2 years, and it does give you some idea of what's happening in the next 6 months to a year. And then you can take a look back to see, based on what you've budgeted, how well you were able to guess as to how your funds should be spent and how they actually are spent. So there are also goals to help you to attain those goals. Using a budget will allow you to be able to monitor what you're doing and take a step back, make changes, and then proceed forward again. Budgets should never be static. They generally should be evolving and working with the organization in their goals and in their mission as they have actual information to compare it with. Participative governing. Budgeting is important, but it is absolutely critical that every person who's involved in budgeting have a say in what information and what numbers are used in the estimates. The preparation of a budget should never be by one person. It should be a team of individuals coming together, working on, gosh. In this presentation, it does mention the budget committee. I don't know if organizations have a formal budget committee. My point with this particular process is get everyone involved who will be held accountable to that budget. Everybody who needs to be involved in the budget are those who will be using funds to carry out the organization's mission. That could very well be lower level management. That could very well be senior level. That could be the line managers. That could be people who are actually involved in day-to-day activities. The most important thing is to involve everyone. I believe from experience that budgets that are prepared with multiple perspectives are probably possess I would say the most accurate estimates. And I would say if you're going to use a budget, you want that budget to be accurate. Now, again, budgets are prepared using estimates, and there's no question about that. But you don't want a budget that is totally wrong, that's totally misleading, that's not useful. So when you have everyone involved in that process, you're highly likely to have a budget that makes sense, that can be followed, that will be that could really track well with actual activities. So the planning of a budget, you're going to make certain that you have everybody involved, that everyone understands their role, that you communicate, of course, and you coordinate with individuals. Bring with you all of the data that you need to help us create these estimates that are realistic, that are practical, that we can actually do. A budget is a roadmap. It really is. And it's something that's going to be helping you make a decision step by step. So it really has to be a practical one. It has to make sense because you're going to be benchmarking that with your actual. And it would be so embarrassing to have a budget and then all of a sudden you realize your actual was way off. Why? That's the flaw of the budget because you're not getting people involved. You're not taking it seriously. You're not planning sufficiently well. You're not coordinating with individuals who actually know what it takes to get certain things done and the price tag associated with that. So there's no question how important it is to plan. There's no question how important it is to have everyone involved and participating in that process. And it's equally important to have a budget that you can actually track, monitor, and benchmark. At the end of the year, you want to, or 3 months or 6 months, you want to be able to go back and take a look at that budget and see how well you tracked with your actual spending. So a master budget combines a whole lot of different budgets in one big budget. Financial budget, operational budgets, cash flow budgets, all of those are all part of this big master budget. And as mentioned, an operational budget is going to tell you what the operations for daily activities of the company. Financial is going to talk about the cash budget, the capital expenditures, which we talked about in a previous conversation. And again, it's all about us being able to use a budget to show us as a plan of what we're going to do up throughout the year, and then using that benchmarking to track what we've done, how effective our budget planning process has been. And again, this is just a good summary of the type of budgets within a manufacturing entity. They want to have a production budget. They want to know how many units to produce. They want to know the materials they need to produce it. They want to know how many people in terms of labor that needs to be done. And also they want a budget for the overhead. Then you have your operational expenses, which are going to be, other types of things, so rent, facilities, and other types of costs. But then you want to be able to prepare an income statement, but a budgeted one. And again, that budgeted income statement is going to be compared with the actual income statement. Because why? We want to be able to track variances. The whole point of all of it is to prepare a budget that you can compare with something else. This is what my reality is. This is what I budgeted. And what's that difference? That difference is the variance. And we need to explain why did you deviate from your budget. These are our critical markers as to the effectiveness of managers. So we want a realistic budget. We want a practical budget. We want a budget that we can actually put together and make work. But at the end of the day, the benchmarking side of it is going to be, did you overspend your budget? Did you underspend your budget? And why? Preparing your operational budgets. Again, your sales budget is going to be how many sales do you need to get your target. And it's very straightforward. And again, looking at the example here, it's not much to it. Each month that you want to project, how many units of sales, and then a cost by sale or by the actual price of those products. That's going to be, again, your sales budget because it's going to drive everything else. So generally, when we're doing a master budget, we're going to start with the sales. The sales is going to drive the production. The production is going to drive the direct materials. The production is going to drive the direct labor. All of these things work together, but it really starts with your sales budget. And again, here we are talking about our production budget, getting down to the nitty-gritty of it. How do we determine the units to produce? Because that's the sole purpose of a production budget. We are trying to determine how many units to produce. Why? Because they're going to tell us how much direct materials we need to purchase. When you talk about all of this, it's all about being efficient. We want to be able to produce a certain amount of product. We need to know how much money we need to spend on the materials and how many hours need to be used in terms of labor and overhead in order to have a comprehensive budget that really shows exactly how much sales we're going to create, how much it's going to cost us for our production, how much it's going to cost us for our labor and our overhead, how much of this costs are going to be associated with different areas of the manufacturing process. So, number one, we're going to calculate the unit that we need. We're going to calculate how much inventory we expect to have on hand. We're going to subtract what that company already has on hand, and that should give us the number of units we need to produce. Very, very, very straightforward. We need to know how many units we need to produce, because if we know that, then we can create our quantity that we need to purchase, which is our direct materials. And again, it is the relationship between the quantity we need to produce, our desired ending inventory, and our beginning inventory to come up to our quantity of direct materials we need to purchase. Why is this important? These are all related to one another. If we know how many sales we want to generate, then we can back into how much we need to produce. Then we can back into how much materials we need, and then we will be able to know how many people, how many hours, and our total direct labor costs. Again, it's all about different parts being fit very neatly together to give us a picture of how we're going to create or how we're going to manufacture our products for the next year or the next 6 months. And again, as I mentioned, when you have all individuals involved in the process, when you have all of the individuals who are a part of that process, even down to the manufacturing plant operators, these individuals know what it takes to get a particular product manufactured. They know what process, they know how many hours, they know how many hours it takes to produce a product. They know how many individuals that are involved in the process. They know how much material they have on hand. All of this information is absolutely critical, because that is going to give you the most reliable and highly accurate estimates of what you need in order to create this budget. At the end of all of this, then you're able to create a budgeted income statement. And again, it's a regular income statement. The only difference is based on estimated numbers, budgeted numbers. But it's important, because when you are using your budgeted numbers and they're highly accurate, when you actually prepare your financial statements, your income statement, you can actually use that as a benchmark and say, well, we budgeted X amount and our actual is X amount. We have a variance, but it's not so big. It's a small variance. And in terms of the number of units that we sold just as many as we had budgeted. That's a very good thing. That means that our budget for sales was highly accurate, and we met our goal. In some cases, you may have exceeded our goal. The most important thing about budget is a tool for accountability. It is a very good measure when done correctly, when done accurately, when done with all individuals who are relevant to the process and being involved. A budget can be extremely helpful in telling with an organization and their staff. It evaluates their performance. It really does show the good and necessarily not the bad as well when the organization is performing their work. How well are we doing? Do we need to improve in an area? Why is there a variance in this particular area? Do we need to decrease our costs? Did we not consider something? Very, very important questions that need to be asked, but are not necessarily asked if you're not taking the budget process seriously and you're not utilizing all of the experts in preparing this budget. So a budget is not something static. It's something that's very, very important. And I think that once it's done well, it could truly be a very effective planning tool. Prepare the financial budgets. Again, financial budgets are going to be the capital expenditures, the cash collections, cash payments, combined cash budget. And reason for this particular part of the master budget is so that you can be able to, again, as we mentioned in previous chapters, when you're making these long-lived asset purchases, you need to be able to be careful and monitor the flow of cash. And capital expenditures can be very expensive. These are long-lived assets, and they have 2, 5, maybe 10-year life, and they're not necessarily cheap. So the capital expenditures budgets are going to have to be very, very careful, because they're going to be drawing on or using the cash flow of the organization. Cash collections is important too, because you want to be able to make certain that the revenues that you that you have earned, that you're actually getting the money from your clients. And being able to track the flow of cash is vital. I think cash flow is the blood of an organization. And if the blood flow gets backed up, the organization eventually dies. So cash collections, cash payments, cash flow in general is absolutely vital for an organization. And a cash flow budget provides very useful information, and it does act as a buffer when you're talking how well are we spending our money. And it does show, not only are we making sufficient revenues, but we're actually collecting on our revenues. We're collecting on a certain amount of days. We're not getting 90-day payments. We're actually getting our monies within 15 to 30 days. And it does give you some idea of the financial health of an organization, when an organization can track the flow of their monies through effective financial budgeting, particularly with collections as well as payments. This is just giving you an example of what a typical capital expenditure budget would look like. It could very well be different depending on the type of assets that this organization has acquired or will acquire over the period. Also, the cash collections budget is another example here for you to take a look at. Many different variations of how it would look, but in the end, you're trying to find out how much cash you're going to have collected in any given month. And again, having cash is king. You need to make certain that you have sufficient cash to pay your bills when they become due. A cash collections budget will alert you if something could go off and what impact it would have. So having a cash collections budget is quite important. Payments, again, not only having the money in your bank account timely, but being able to work on the focus on the timing of payments to your vendors, to your suppliers, and also most certainly to your employees. So cash payment budgets are quite important. And here's an example of what one would look like for a given quarter. And again, as I mentioned before, these budgets are estimates, but if they're done well, they are very accurate estimates. And they are as a tool to help explain how efficient or inefficient the organization's using its cash resources. Here's another example of what a cash budget will look like, considering overhead and for operational expenses. I would say a cash budget is something that you and I do every day for our own business, or our own lives, quite frankly. We get our paycheck and we have expenses that we have to pay, and then we hope if we do it right, we have some money left over. Very simple and very basic, and it's absolutely relevant in practical experience in our lives, whether we have a business or not. We still have to mentally consider the flow of cash for our personal bills. And maybe if we do it right, we might have a little extra to save. And here's a cash payments budget example. It gives you the type of categories of cash payments and for each respective month and for the quarter. Having an idea of what you're going to pay and having it written down does make a difference. It really puts things in perspective, allows you to see what's happening, and you can make sound judgment based on truly what's going on. So a combined budget, the master budget is a combination of a sales budget, a production budget, a direct materials and direct labor budget, a capital or a financial budget. It combines all budgets into one big massive document, and it is an absolutely vital tool for an organization to plan their operational activities around what money's coming in and how that money is to be spent. It is also a tool to allow organizations to hold managers and directors and agents and different agents responsible for their portion of the job, how well they're performing. It does give them an idea how well they're doing their jobs, and very important. But it also can tell you when something is going wrong and gives the organization tools to help them to change course if something's not working. A cash budget will let you know in advance that you might be short of cash. The question then becomes, do we stop production or do we use monies from borrowing to cover that? Lots of good questions, and a budget allows you to answer those questions. And here's a copy of the budgeted balance sheet. give you an idea of what it looks like. It looks like a standard balance sheet. The only difference is the numbers here on this budgeted balance sheet are estimates, and they are useful because they will be a reflection when compared with the actual. Sensitivity analysis is just what if technique. What if we did this? What if we did that? And it's really important because it allows the organization to step away from really strict rules and just try to see if we made some assumptions. If these assumptions panned out, how would they affect a process? Sensitivity analysis allows you for flexible budgets. And these budgets are just, they vary based on different volumes of activity. Again, these are internal documents. So that's kind of important that they have a flexible budget that we can change and modify based on new information that we might have. So budgets for a merchandiser, obviously a merchandiser doesn't have any merchandise inventory. They basically will be a sales budget, operating budget, and expense budget. So here is a very, very quick overview of what it would look like for a service company. So in all of that, budgeting is a relevant tool for merchandising firms, for manufacturing firms, as well as any company that needs to be able to track their operating activities and their cash flow activities. It is a useful tool when done as a participatory process, can be highly accurate and an excellent way to benchmark as well as to hold management and leaders accountable for their work. And this is another example basically of cost of goods sold and how it is useful in determining what inventory that needs to be purchased. Now, I'm not going to go deep into all of these different types of budgeting because it's beyond the scope of this course, but I do want to say that if you think about your own personal financial situation, in some way, there have been times that you possibly had to budget, even if it's in your mind, how you're going to spend your financial resources. Consider how important it is for an organization to do the same. I want to thank you very much for listening to me during these past 6 chapters, and I'm hoping that you're able to grasp some information that you can use on a daily basis. We want these courses to be practical and that you can apply the concepts in your daily life and, if possible, in your work. Take care and thank you again.